Hello, Matthew Bell here, and today I wanted to talk just a little bit about an item that's been in the news recently. I am recording this in 2019, and one of the news items that seems to be cropping up every few months is regarding long-term care insurance. In particular, there are a number of companies that have initiated rate increases or rate hikes. General Electric, there was an article just recently, and I think that appeared on CNBC, it looks like from my notes here. And the basic crux of that article was that GE is being accused of fraud, and it's with respect to cooking its books or basically fudging its bookkeeping numbers regarding the losses it's sustaining for long-term care insurance policies that it has within its company holdings. So I thought I would just talk a little bit about some of the issues, talk through them, and maybe discuss what is going on and some things that are potentially solutions to it. So long-term care insurance is basically where the insurance company is taking on some risk. Again, all insurance is basically based on the idea of risk transfer. So you, for example, might pay for insurance on your home. Homeowner's insurance in case the home burns down. It's not going to be you who has to pay to rebuild your home. It's going to be the insurance company. So generally what happens is you're going to pay in some amount of money over time, a premium, and that premium is going to protect you up to certain limits and with certain conditions and however the contract is written. But if you sustain the insured against loss within that coverage period, then you will find the insurance company will pay the money to indemnify you against the loss, or to make you whole again, essentially, is what indemnify means in this case. So with that in mind, long-term care insurance can be used for a number of things, but one of the things that it's primarily used for is to protect you against the risk of having to pay your own assets and income for your care if you were ever needing to go into a nursing home. It's a little bit more complicated than that because some policies include the ability to pay out if you are in your home, so they pay for home care or assisted living or respite care and hospice, and some other care environments might be included. But just to keep it kind of easy and intuitive, long-term care insurance is going to basically cover you against the loss of having to go into a nursing home, the amount of money you'd spend on that. I get into that elsewhere. The average cost is going to be around $80,000 to $90,000, depending on if you have a semi-private or private room in the United States. The median cost in my area is about $100,000. So I just to give you an idea, we're talking big money, $80,000 to $100,000 a year, and that's if you don't need memory care. Well, there are insurance policies that purport to be able to protect you against this kind of thing, so that if you needed to get into a care situation, you would be able to file a claim, and the insurance company would pay for some of your or all of your care, depending on the level of benefit you've selected and other things. Now, there are certain triggers, and I don't want to make this video about long-term care. I have other videos that are specific to long-term care, but suffice it to say that there are certain triggering situations, and there's what's called in the jargon activities of daily living. So, for instance, if you are deficient, if you lack 2 out of 6 of what are listed as the activities of daily living, and these are things like being able to feed yourself and bathe yourself and that kind of thing, then you are long-term care qualified. And there's a separate trigger for cognitive impairments. So lacking certain physical abilities, lacking cognitive abilities, these are all triggers. Now, basically, when a person signs up for a policy, they sign up at a particular level. Now, long-term care is more similar to health insurance than it is to life insurance in this regard. And that is that it's not as clear-cut, I guess, is the best way of putting it. You know, if you're dead, in most cases, you're either dead or you're not dead, and there's not a whole lot of question around whether or not a person is dead. But whether or not a person is qualified for long-term care, there can be a question around it. There can be a question around disability. There can be a question around certain illnesses. So it's similar in that respect to a healthcare product. And the other way it's similar is that in most cases with health insurance, your premiums are going to go up as you age. There are life insurance policies, term insurance specifically, annual renewable term insurance even more specifically, that do go up yearly. Term in general gets more expensive. Any insurance is going to get more expensive, but in certain policies for life insurance, once you have a premium, it's locked in. But with long-term care insurance, this may or may not be the case. And in most cases, most people do not have policies that are what are called non-cancelable policies. In a non-cancelable or non-can policy, there would be no rate increase. You're guaranteed, hard guaranteed, to have that same premium for the rest of your life. Most of the policies are guaranteed renewable, which means that you will not have to worry about losing your benefit, but in some cases you may be susceptible to a rate increase. And this is exactly what's happening. So in the news, just over the past year or so, Mass Mutual, a well-respected insurance company, has had to raise or request rate increases of up to 77% of its long-term care policies. John Hancock has had to do so. Genworth has had to do so. And the percentages here range from 50, 60%, 70%, as I just said, for Mass Mutual, all the way up for some smaller companies, according to one article I consulted, 200 to 300% rate increases on insurance policies. Now, this is coming to a head. These rate increases have been requested because the companies have questioned their ability to pay out benefits to people if they actually file claims that are sustained. And so this is a real problem, because people have paid into these policies for many years, decades in some cases, and the insurance companies are coming back and requesting additional money. And really, one way to think of it is it's kind of a last man standing kind of problem. So to get to what I mean by that, and to kind of get a handle on it, let me kind of dive into what the actual problem is supposed to be. And it's multiple, but there are a number of considerations, and a number of them stem from bad actuarial information in when these policies were first rolled out. So here's what I mean by that. In order to guard or insure against a particular loss, an insurance company has got to be able to predict with some degree of accuracy what the chances are that a given person or given group of people are going to sustain a particular loss. And so this operates on what's usually called the law of large numbers. So the larger the sample set that you have, the more reliable can be your estimates. But part of this, and when you read these articles in the news, and it's not funny, but there's just a phrase that keeps cropping up, and that is emerging experience. And here's the idea, is that they're basically saying we don't have a lot of experience with the risks that are relevant here. We don't have a lot of experience with Alzheimer's and other cognitive impairments, which are just seemingly now starting to become a problem. They're on the rise. And so this emerging experience has caused these insurance companies to basically have to confess that they don't know how to gauge the loss correctly. Now, that didn't stop many of them from coming out with policies, like I said, 10 years ago, 20 years ago. And so what they were doing was coming out with policies on the basis of their best guesses at the time regarding loss ratios and that kind of thing. And to put it bluntly, they were wrong. And so they gauged in terms of how many people would need long-term care. They were wrong about that. They were wrong about how long people live once they have care. They were also wrong about how many people would keep their policies. So insurance companies realize that a certain number of people who buy insurance policies are going to let them lapse. They're going to stop paying premiums. They're going to, for some other reason, they're going to run into hard times. They're going to cancel their policies voluntarily. And so these numbers go into calculations regarding legal reserve. So an insurance company has to have money on hand to pay out claims that it sustains in a given year. But when you think about it, this is how property and casualty companies along the coast sometimes get wiped out after a hurricane, because the hurricane raises the amount of claims that they have to pay out, and they weren't equipped to have to pay out to such a degree. So a natural disaster can bankrupt property and casualty companies. Well, long-term care is proving to be something of a hurricane for the long-term care insurance industry. And the idea is if they end up in a situation where they have to pay out more benefits than they thought they were going to have to, then their legal reserves may be exhausted, and in that case, people are either going to not get benefits, the company may have to, admit its insolvency, and then you've got a huge assortment of problems. But it started with these actuarial difficulties. So just a word on legal reserve, because this actually cropped up on some of the articles. I was looking at a Reuters article on General Electric's current problems, and according to the Reuters article, General Electric presently has about $55,000 of legal reserve per long-term care insurance policy that it has. Now, there is some question in my mind as to how to actually read that number, but one way of reading that would be to think of it again in terms of your average nursing home stay in the United States is going to be around $80,000, no less, 80,000, 90,000, 100,000. So if a long-term care insurance policy only has about 50, 55,000, and some of them even have less, some a little more, but then they can't even afford to pay for 1 year of your long-term care. And presumably, many of these policies were multiple year policies. You might have a 1 year policy, you could have a 3 year, a 5 year, a 10 year. Some companies in the past offered lifetime policies, so that if a person happened to be in a nursing home for a couple of decades, the policy would just continue to pay. Now, statistically, that is an unlikely situation. However, it does happen to people. Statistically speaking, we're talking maybe 1 to 5 years in terms of nursing home, confinement when a person has some kind of a cognitive disability in particular. But still, the point is that the legal reserves, the amount of money that these companies have assigned or earmarked for paying claims, is insufficient to pay what you would reasonably assume might be a claim amount. So for a long-term care policy where a person may be expected to be in a nursing home for, let's say, 3 years, you would expect that that company would have $300,000 in reserve for that particular policy. And again, we can't think of this as if the companies just have a tin can with your name on it and they put, $300,000 into the thing. It's more complicated than that. So it's not entirely clear to me how to read that number, but the gist of the article is that there are people who are concerned that the insurance company's reserves are not sufficient to pay the claims that they think they're probably going to have to pay. Now, in the past, GE actually owned a company called Genworth, but it is my understanding that Genworth now is its own company. And so in the article, and I had to dig for this, but one of the articles on GE suggested that really what we're dealing with in General Electric's case is what's called reinsurance. And a couple of names were mentioned, Employers Reassurance Corporation and Union Fidelity Life Insurance Company, which are apparently reinsurers, meaning that they are taking on risk that other insurance companies sell to them. So there's a thing in insurance, and this is very common, reinsurance, where certain risks are spread. And this is similar to diversifying your own portfolio. An insurance company may not want to take on all the risk of everybody that it insures. And so in some cases, at certain dollar amounts or for certain types of risk, the insurance company may spread that risk around. In case it has to pay out an exceptionally large claim, it may call on other insurance companies and have sort of what they call treaty agreements with those companies in order to share some of the payout that may need to be come up with. But the idea in the article was that General Electric's books are very bad because the amount of liability that it has for these reinsurance claims exceeds its ability to pay. And that's the real gist. But in many cases, the long-term care companies can go to the individual insurance commissioners in the various states and request rate increases. And that's what we started by saying. Mass Mutual, John Hancock, Genworth, these companies have been doing that. But General Electric is unable to do that because as a reinsurer or as the owner of these reinsurance companies, a reinsurer cannot go to the state commissioner and ask for rate increases. The primary insurance companies have to do that. And so it's a very complicated situation, especially when you factor in that the average age of the policyholders in question here is 77 years old. So they're right at the cusp. In other words, there could be a real increase in the number of claims that is filed on this. But there's an additional. So we sketched 3 problems. Number 1, inaccurate predictions of who would need long-term care. Number 2 is inaccurate predictions about how long a person would live once they need care. Number three is inaccurate predictions about how many people would keep policies in force. But the fourth thing is actually the low interest rate environment that we've been going through these last couple of years. And here's how it affects. Insurance companies cannot have funds invested in very risky ventures. And the reason for this, and it's usually proscribed by state law, is that the insurance companies have to have money on hand to pay their claims. So there are certain investment classes and asset types that the insurance companies are not permitted to put their money into. And so in many cases, insurance companies are very heavily invested in the bond market. And the information, just on a quick Google search, the National Association of Insurance Commissioners, the NAIC, in 2010, or at least they published a report that was based on numbers that were in 2010 as to what types of investments insurance companies utilize. And according to their numbers, almost 70% of the money insurance companies have on average is put into the bond market. Around 10 to 11% are in stocks, 6% approximately are in mortgage and liens, and about 8% are in things like cash and what are called bankers' acceptances. And then the remaining 5 or so percent are a mixed bag. But those were the heaviest ones. So if you notice, 70% of insurance company money is generally in some kind of bond. And so because the interest rate environment has gone down so low, and as I'm writing this, the Federal Reserve just cut the federal funds rate an additional 25 basis points, meaning 0.25, and now that federal funds rate, or the rate at which banks lend money to one another, is now in the range of about 1.75 to about 2.0. Now this means that there has been an additional decrease. The interest rate environment has just gotten even worse, if you want to call it, lower. And there are reasons for it, and I'm not going to get into that, and in fact I'm probably not competent to go into that too far. But suffice it to say that if the interest rates drop, and if the bond market then is not returning as much money, and if the insurance companies are heavily invested in bonds, then the bottom line is the insurance companies are not making as much money on their money as they thought they were going to. Now, one would hope that they have sophisticated enough actuaries and people looking over this that it's not a surprise to these insurance companies that this is a possible state of affairs. In other words, one would hope that people who are in charge of investing insurance company funds are not surprised that the Federal Reserve is capable of cutting the federal funds rate this low, or that it is possible that their bonds are not going to return what they anticipated. But this is a factor because the reserve, the legal reserve that an insurance company has, is not, again, a static thing. It is a prediction in essence, and it's a dynamic thing. It depends on their actual experience of loss and risk. It depends on how many people are making claims. It depends on the return they get on their investments. And so when the return is low and when people are making more claims, then their legal reserve can be taxed to the breaking point. Now, a number of these articles interviewed retirees and seniors, and they were understandably upset. One couple's premiums went up literally 123% in the article, from about $4,000 all the way up to about $8,800, so $3,979 all the way up to $8,876. So that a huge increase. Now, that couple stated that they just wanted what they paid for, and they thought the insurance company should just eat the loss. The trouble is the magnitude of the loss that the insurance company would have to eat. To put it directly, that level of loss that we're describing here could literally put the insurance company out of business. And so in a sense, what we're describing is the difference between having to pay higher premiums or having no benefits whatsoever. And the difficulty, of course, is that many retirees and seniors are on a fixed income, and they don't have the ability to come up with the extra amount. So they've paid into policies maybe for years, and all of a sudden, as they near the age where they would actually have to avail themselves of the benefits of these policies, potentially, the premiums go up so high that they can't afford to keep the policy in place. It's a real problem. Now, possible solutions are basically, what you would anticipate. You could pay more premiums, and this is the way the insurance companies are approaching things in the main, is they're going to the state commissioners and asking for permission to raise the rates. So that's one solution, and at least a workaround is put more money in. Another one would be to decrease the number of policyholders. And if more people cancel their policies, then the reserve calculation is going to change. Obviously, this is not necessarily something in the control of the insurance companies. Some people suspect that in virtue of asking for these rate increases, the insurance companies are trying to get people to cancel their policies. So in a sense, if you can put more money into the system, you're better off than you were. And if you can get some people to cancel their policies, then the system is better off than it was before. Obviously, these individuals are being impacted by this in their lives. So again, I say this is a serious problem. But the third possible option is to reduce benefits. So sometimes insurance companies may say to you, well, look, we can raise your rates, but we'd prefer not to, but then we have to reduce the amount of benefits, so we can't give you everything we promised. Another possible solution would be to allow the insurance companies to invest in riskier or potentially higher return investment instruments. I'm not so sure that this is one that anybody really wants to implement, simply because if it pans out, it could work, but if it doesn't pan out, the situation could become exponentially worse. Another one that was an interesting possibility was the idea of introducing co-payments. So John Hancock apparently is now starting to basically say, well, look, we prefer not to raise your premiums, we prefer not to drop your benefits, but we are going to have to then institute some additional thing in between to say, okay, you're going to have to pay extra as a copayment. Now, how is that not a premium increase? Well, the premium increase would affect people whether or not they ever end up claiming, whereas a copayment would only affect those people who end up having to claim. Now, once again, nobody should be cavalier about this, because the very people who purchase these policies, when they need to file a claim, they probably are experiencing a number of hardships and a number of increased medical bills and the like of that. They're probably seeing an increase in their health expenses and medical expenses. So there's no easy solution, but putting additional premiums in, decreasing the number of policyholders, decreasing benefits, investing in riskier or higher return investment instruments, or introducing copays. Those are 5 solutions or workarounds that have been proposed. There's a possible alternative, and I say this in other videos, but your alternatives are pay for the long-term care yourself. If you don't have the money, or if you exhaust your money, then your basic recourse would be Medicaid. So again, long-term care insurance has an appeal to some people, but what's little known is that you can sometimes think of life insurance in a way that would enable it to contribute meaningfully to this problem and these questions. That's a little bit more complicated than I'm going to get into now. We've already been going a while. I invite you to check out other videos where I explore this. Sometimes it's due to riders, chronic or long-term care insurance riders that can go along with a life insurance policy. But in other cases, it's just the concept of this. My dad was in a nursing home my dad Jim, and he died in 2016. He was in a nursing home for 4 years, and it basically cost our family $300,000, and Medicaid was needed to be invoked in order for us to cover that payment. But if we had private paid, if we had had $300,000 for his care, and my dad had had a $300,000 insurance policy, then in theory, the amount of money we spent for his care could have been restored to the family upon my dad's death. So now this is just conceptual, very basic. I get more in depth on this in possibility in other cases. It's a crapshoot. I mean, it's a probability judgment. There it could have been any number of things that can affect this kind of plan. So I guess the bottom line that I would encourage people is have a plan. Think through what you might be expected to pay for your care, what it might cost you. The estimates are just troubling, and what's going on right now with the long-term care insurance industry is also troubling, and so there are no easy solutions. I invite your comments. If I know the video content isn't happy content, but if there's something that I said that may have proven of use to you, I do ask that you like the video, subscribe to the channel. It helps immensely with the impact that I'm trying to have, and I appreciate your time, and I wish you well, especially if one of your family members or you yourself are implicated in some of these troubles. Please check back. I'll have additional content shortly. Thanks a lot.